Welcome and thank you all for joining us today at this briefing session on the HAFF and NHAF Legal and Commercial Framework. I'm Lisa Merigliano, Director of Major Programs at Housing Australia. To begin with, I'd like to acknowledge the traditional custodians of the various lands on which we all meet today. I'd also like to pay my respects to their elders, past, present and emerging, and extend that respect to other Aboriginal and Torres Strait Islander people present. Next slide, please. So this is a technical briefing session to help eligible applicants to complete their response to the call for applications in this program, the Housing Australia Future Fund Facility and the National Housing Accord Facility, the HAFF and the NHAF. The focus of today's session is the funding documents. These are effectively the legal contract documents that successful applicants through the HAFF and NHAF program will enter into for the duration of the term, which could include, in some cases, the delivery and construction phase, and in all cases, the 25-year operating phase. I'm delighted to be joined today by Nikki Robinson and Kathy Santikos, partners at Clayton Utz, who have been advising Housing Australia on the funding documents. Nikki will walk us through the contract model and the key legal principles and provisions, and Kathy will provide an outline of the security and intercreditor arrangements. So I'll do a brief intro and then hand over to Nikki and Kathy to run through their presentation. So we might only need about an hour to cover the material. On Friday, we released the funding documents that now form part of the suite of documents to support the call for applications for funding round one. They were published in the HAP, the Housing Australia portal, via an addendum to the CFA. The funding documents comprise a framework funding agreement and a financier tripartite deed. I do hope that people have had a chance to have a look through them. So how did we get here? In the lead up to finalising and releasing the funding documents last week, we undertook an open consultation process. The draft framework funding agreement was available for download via a data room between the 19th of December last year and the 22nd of January this year. And the purpose of the consultation was to market test and obtain feedback on the structure, practicality and bankability of the commercial and legal framework presented through the documents. Feedback was received from a number of parties, including peak bodies, community housing providers, state and local government, developers, investors, arrangers and banks. And we really do want to thank all of the parties and their lawyers, of course, and advisors who took the time to read the documents and to give us their feedback, especially over the Christmas and New Year period. All participants in the process, as well as us at Housing Australia, will benefit from that. So we've spent the last 3 weeks intensively reviewing a lot of feedback in great detail. So that's a lot of time with Clayton Utz, just as well. They're really lovely people as well. Thank you to Nikki and Kathy, as well as Joe Pugsley and Peony Gebby in the Melbourne office for doing an incredible job to process and analyse all of the feedback, draft the relevant adjustments into the documents, and work really closely with us to produce this suite of funding documents. As Nikki and Kathy step through the framework, they'll also point out where we've made key changes in response to the market feedback. One of the key objectives of the consultation process was to encourage effective participation in the program by ensuring that the contractual arrangements are suitable to a broad range of applicants and their investors and financiers. The idea is to standardise the documents in order to be more efficient with time and cost, and also to minimise the legal departures bid back through the application process. So on this basis, Housing Australia expects to not receive departures to the funding documents. Any departures that do need to be bid back really should be limited to the points that are strictly required to accommodate the applicant or project-specific matters. So in submitting any departures, they'll need to be fully drafted in markup in the relevant funding document, showing the exact proposed changes together with a full explanation, and they will be assessed as part of Evaluation Criterion 5 to determine the impact on Housing Australia's commercial position and risk profile, as well as our ability to achieve contract close within an acceptable timeframe. So today's session doesn't include time for a Q&A, but I do encourage you to read the final funding documents, as well as any frequently asked questions that have been answered in the Housing Australia portal already, and of course obtain your own legal advice. If you do still have questions, please submit them through the Housing Australia portal in the Q&A facility following this session. So I'll now hand over to Nikki and Kathy to talk you through the funding documents in more detail. Thanks, Nikki.
Thanks, Lisa. As mentioned, I'm Nikki Robinson, a partner at Clayton Utz, and I'll be presenting today with my fellow partner, Kathy Santikos. We're part of a broader team here at Clayton Utz, assisting Housing Australia with the legal aspects of the rollout of these funding programs. As Lisa's mentioned, the purpose of this session is to outline the changes that have been made to the legal documents following market consultation that was undertaken. In order to assist in laying the foundation for the discussion, I'll start today by doing an overview of the contractual model that has been put together. Each successful recipient must enter into a framework funding agreement, referred to at times as the FFA for ease, and for each project, a project agreement. The framework funding agreement and project agreements for each project will be executed simultaneously at contract award. The party who signs the framework funding agreement must be identical to the party who signs each project agreement. In effect, it has to be the same legal entity. So the slide up on the screen now shows diagrammatically how many agreements will need to be signed based on how many projects are selected for funding by Housing Australia in this round. So basically, if you only submit and are successful for one project, you'll sign two agreements, the framework funding agreement and the project agreement. And where there are multiple projects, individual project agreements for each project. The only variation to this is where a recipient has made an application for funding for a portfolio of projects. The projects must be in the same state and territory, and only one project agreement will be entered into for the entire portfolio. And correspondingly, only one availability payment and one concessional loan if one is applied for, will be granted across that portfolio. Next slide, please. So this slide looks at the different parts that make up the framework funding agreement. The agreement includes general terms of engagement within the framework funding agreement itself, a template schedule, which on contract award will contain the details of each individual project, noting that the information to complete this schedule will be taken from returnable schedules provided under the call for applications. Then there are a set of common terms set out under attachment 2 that outlines the key terms linked to the funding, and it's here that you will find further details around events such as extensions of time, the look forward test, obligations around performance during both the operational phase and the development phase, and default and termination. Then there are schedules to the common terms, which provide specific provisions relating to each type of financing product. For example, the availability payments and the concessional loans in this funding round. Upon execution, the contractual relationship between the parties for that project comprise the project schedule and the common terms, and together these will form the project agreement. Each project agreement will be an independent contract that will continue in accordance with its terms until its expiry or early termination. As mentioned, the information provided as part of the returnable schedules under the call for application will be used to populate the schedules and attachments to the project deeds. This will include information such as tenant cohort, the type of dwellings being provided, the approach to be taken with regard to both the development approach and the operational phases of any project, and any security requirements, depending on the type of funding being provided. Next slide, please. Funding under the programs may comprise all or a combination of, for this round, availability payments and concessional loans. Availability payments will be paid as recurring quarterly payments in arrears during the operating phase of a project, referred to under the project agreement as the availability term, being a term of 25 years. Concessional loans, which are interest-free loans for up to 10% of the project cost, are also for a term of 25 years or longer if made available during the operational phase to support the delivery of the social or affordable housing. These loans are available to be drawn down from financial close at requested points during the development phase, with a bullet repayment at the maturity of the term. Applicants seeking a concessional loan for a project must also be seeking an availability payment for that project. By exception, Housing Australia may make concessional loans for up to 30% of the project cost. And if you're looking for the circumstances where this can be applied for, section 3.11 of the call for application sets out the circumstances where Housing Australia will consider increasing the amount of a concessional loan above 10%. Also, as outlined in the call for applications, it is not proposed that grants will form part of this funding round, although upfront non-refundable capital grants may be available by Housing Australia in exceptional circumstances. And for example, where the proposed housing outcomes meets a high need, but the project is extremely financially challenging. And this could include housing in a remote area, housing that is for a high need or particularly vulnerable cohort, or is for Aboriginal and Torres Strait Islander people. Next slide, please. This slide shows diagrammatically the different phases within the Framework Funding Agreement from the time the agreement is executed by the parties on the award date, as shown, until the final expiry date. There are basically three distinct phases. The first phase is the period that commences when the Framework Funding Agreement and projects agreements are signed on the award date until when financial close is achieved. Financial close signifies the commencement of the second phase, in most instances, the development phase. The development phase will conclude when the operations commencement test has been satisfied for the project specified dwellings. This signifies the end of the second stage and will trigger the commencement of the operating phase, being the third and final phase. The availability term commencing on the date the first completed dwelling is occupied, and the term will run for 25 years. I'll now outline how a recipient will move through each phase in more detail. Next slide, please. This slide steps through each of the conditions that may need to be satisfied between the period from contract award to financial close. The first phase. Financial close will occur once all conditions precedent have been satisfied or otherwise waived by Housing Australia at its sole discretion. These conditions include receipt of all planning approvals required for a project. Where a project is reliant on additional external funding, it will be a condition that financial close under any senior debt facility agreements have also been satisfied, and that registration of any relevant security interests and execution of any relevant intercreditor arrangements has occurred. Where the housing provider is a registered community housing provider, evidence that they are in fact registered. Where the recipient is an SPV, that the relevant member of that SPV can show it is registered as a charity. A declaration that the dwellings are or will be HAFF or NHAF construction compliant if they are required to be so. Evidence that any person required to be accredited under the WHS scheme is accredited. And finally, they must provide copies of any other approvals or assurances reasonably required by Housing Australia under the project agreement. The date for achieving financial close will be based on the date submitted under the CFA by the applicant. The revised agreement now allows for the recipient to seek an extension to that date by up to 18 months, but only where there is a delay in obtaining a planning approval. There is no right to seek an extension of time for delays in achieving satisfaction of the other conditions. And also, any extension due to a planning delay is capped at 18 months. The reason this extension right only applies to the planning conditions is that the purpose of this funding round is to seek to have capacity of additional dwellings for social and affordable tenants delivered as quickly as possible after contract award. Next slide, please. The focus during the development phase is to ensure on-time delivery of the specified dwellings for each project. Housing Australia, as Lisa mentioned, received significant feedback, and much of it was on what events should be included in allowing for an extension to the operating phase commencement date and for the period of time that should be permitted before a key default event is triggered where there is a delay. A number of changes were made to address this market feedback, in an effort to balance the requirements of both parties. And I'll talk through these changes. As indicated in the draft framework funding agreement released in December, the project agreement now includes a look-forward test that will allow the independent certifier to review the status of the project and report back to Housing Australia on the progress of the project and the likelihood or not that the recipient will commence the operating phase by the operating phase commencement date. Those of you who've had a chance to review the project agreement will see that Housing Australia has placed limitations on the independent certifier's powers to initiate that look-forward test. It can't initiate a review within 12 months of financial close or more than once every 6 months. If the independent certifier determines that the operating commencement date will be missed, the recipient will be required to prepare and to implement a delay cure plan. And this plan will then need to be approved by the independent certifier. The plan can indicate a completion date that extends past the original operating phase commencement date, but there are limitations on the length and the basis of such extensions. Failure to implement the plan is now a key default event, noting in the draft document Housing Australia released prior to Christmas, it had the right to terminate the project agreement where this date was missed. Another change that has been made to the framework funding agreement is that the extension events have been broadened to include some additional events. These include acts or omissions caused by Housing Australia that result in a delay to the project and industrial action not caused by the recipient. We've also expanded force majeure events based on responses to include natural disasters, seismic activity, tsunamis and mudslides. For those of you who are listening to this in Sydney, that will be a welcome announcement. I note here that where an extension to the commencement of the development phase was granted as a result of a planning delay, as discussed in the previous slide, the agreed extension will be added onto the operating phase commencement date, giving this date will have been calculated at the time of contract award based on the original date for financial close. Where an extension event occurs during a development phase, assuming all of the elements required to be satisfied to obtain an extension have been met, for example, the occurrence of the event has actually resulted in a delay to the program, the recipient will be entitled to an extension of time to the operating phase commencement date, noting there is a cumulative cap to any such extensions of 18 months during this phase. This means the long stop date will be 18 months after the operating phase commencement date, as it was at financial close. Where there was adjustments to the operating phase commencement date due to a planning delay, the total possible extensions is 36 months. Next slide, please. This slide provides an outline of the elements that must be satisfied in order to pass the operations commencement test. A recipient must be able to satisfy the following criteria for each specified dwelling. They must have an occupancy certificate. They must have certification from the independent certifier that confirms that all approvals, standards and requirements, including those in the D&C approach provided by the recipient and included in the project agreement, have been met. The intention here is that the independent certifier looks at those things that extend beyond what is in the occupation certificate so that there is no duplication, but that all of the requirements set out under the project agreement can be certified as being met. The recipient must also demonstrate that the housing provider is ready and able to commence delivery of tenancy and management services at the specified dwellings, and that the specified dwellings will fall into one of the following permitted classifications. They are a construction of a new dwelling, purchase of a new built dwelling, renovation of an uninhabitable dwelling, and conversion of a non-residential property into a residential dwelling. Finally, there must be no current key default events as defined under the project agreement and no framework funding agreement termination events as defined under the framework funding agreement at the time the recipient notifies Housing Australia that it believes it has satisfied the operation commencement test. Next slide, please. Now, this slide looks in more detail about what it means for a specified dwelling to be available or unavailable once the operation commencement test has been met. This is of significance to both the payment regime and the default regime under the project agreement. So what is available? Specified dwellings can be available if they meet the availability requirements or deemed available where tenants are housed in a temporary dwelling for a period of up to 42 days or an alternative dwelling for a period of up to 180 days, and those dwellings meet the availability requirements. More specifically, the availability regime has been broadened following market feedback so that a specified dwelling can still be available where there is damage to that dwelling beyond the reasonable control of the recipient, and a temporary dwelling is provided. Temporary dwelling will be something such as a hotel, a motel, or a short-term rental accommodation, and it can be provided for up to 42 days, and that period can be extended where Housing Australia otherwise consents. In addition, there has been some relaxation to the requirements that need to be met by an alternative dwelling, and these include the period to accommodate a tenant in an alternative dwelling without the consent of Housing Australia has been increased from 3 months to 6 months. Also included now is a ramp-up period of 6 months from the date the operations commencement test before the unavailability key default event starts to operate. And this change has been made to provide time to progressively move tenants into new housing. And the re-tenanting period has also been changed. It's 21 days, or in the case of a dwelling in a remote location or that is used to accommodate a vulnerable contracted tenant cohort, a reasonable additional time to be agreed with Housing Australia, plus such additional time as may be required to rectify damage caused by the outgoing tenant up to a maximum additional period of 21 days. And I should note here that the 2% vacancy allowance included in the availability payment calculation, which is in addition to the 21 plus 21 day period for re-tenanting, has been retained. The availability requirement is satisfied where the specified dwelling is occupied and it satisfies the specified dwelling availability test. The specified dwelling availability test means in respect of a dwelling, it has passed the operation commencement test, it meets the requirements for dwelling suitability for either social or affordable housing, as will be applicable under relevant legislation in the primary jurisdiction, and it is safe, secure, affordable, maintained in good repair, and otherwise compliant with the relevant residential tenancies legislation in that jurisdiction. So given that the above description covers off when a dwelling is available, I should note that specified dwellings are unavailable if they are not available or do not meet the permitted availability threshold. Permitted unavailability threshold, means in respect of a specified dwelling, the period of time during the availability term during which that dwelling is not available, but is within the permitted vacancy allowance between tenancies as outlined above, or in aggregate with all other specified dwellings that are the same as that dwelling cohort, is under the 2% vacancy allowance contemplated in the agreement. I do appreciate these are quite complex arrangements when you go through each of them, and it's something which actually probably helps if you have the agreement in front of you when you're looking at what is available and what is unavailable. Next slide, please. So this slide looks at the impact of unavailability during the operating phase. Put simply, as a concept, the recipient is not entitled to the availability payment in respect of any unavailable dwellings. And note that payments will be made quarterly in arrears, and recipients will be required to submit a tax invoice showing the amount of the quarterly availability payment claimed for that quarter. And that invoice has to be accompanied by details around the number of dwellings that were 1, available, 2, not available, but within the permitted unavailability thresholds, and 3, unavailable. And it's worth noting that any deductions are applied at the end of each availability year. So until these are calculated for any given year, the full amount of the availability payment is paid to the recipient. And so where the amount of the invoice is accepted by Housing Australia will pay the invoiced amount within 20 business days. The agreement sets out a process for resolving any disputed amounts in detail. At the end of each availability year, an unavailability deduction will be made to the first availability payment for the following year, based on the formulas that are set out in detail in Schedule 1, noting there are separate formulas for social and affordable housing. The formulas calculate where there have been overpayments during the course of the preceding availability year. It works as a wash-up and deducts any overpayment from the first quarterly payments for the following year. There is a separate mechanism for unavailability adjustments to be made in the final availability year. There is a default regime to deal with unavailability that extends past permitted thresholds that are dealt with by the adjustments to payments outlined above. The regime was amended following market feedback by building in the 6-month lease-up period from the commencement of the operating phase, as already mentioned. The key default event relating to unavailability operates such that at any time during the operating phase after the lease-up period, where 1, the unavailability deduction for any availability year exceeds 25% of the applicable availability payments for that year, or 2, the number of days that a specified dwelling in any 2 quarters fail the specified dwelling availability test is 2% or more of the total number of possible days for those 2 quarters. If either of those events occur, a default event has occurred in relation to unavailability. Clause 12 of the Common Term sets out the regime for rectifying key default events, knowing that a failure to rectify a key default event will trigger rights for Housing Australia to commence the market process, which will be discussed further below, or will give rise to the right to terminate the project agreement where the market process fails. Next slide, please. This slide sets out all of the key default events, noting that the default regime at the project level has 2 triggers: a key default event or a significant event, which is outlined on the following slide. Changes from the consultation draft that relate to the key default events include, firstly, the introduction of 2 new default events, as shown in orange, or it may come up as red on some people's screen. These are delay in the commencement of the operating phase, and we know this has been introduced as a key default event because it was previously an automatic termination event, and it's now subject to the cure regime. And the second new default event introduced was a failure to provide or implement a tenant policy. And this is to ensure that the tenant policies have been put in place and are able to be implemented as soon as dwellings are occupied. The yellow boxes set out those default events which have not been varied from the previous draft document issued for comment. And the blue boxes highlight those events where drafting changes have been made. And these include the default event for unavailability, which, as described earlier, now only applies where dwellings are unavailable after 6-month lease-up period, and where 1, the unavailability deduction is greater than 25% of a dwelling availability payment for that year, or 2, the specified dwellings are unavailable for more than 2% of any 2 quarters. The second one is where changes have been made to the default event where the recipient or its representatives bring the reputation of Housing Australia into disrepute in any significant way. And finally, where there is a change to a debt and equity financing in the financial closed financial model without Housing Australia's consent. And again, these events are capable of remedy, but they will be a default event if they occur without consent. All of the default events sit in the project agreement, and there is a remediation process that gives the recipient the opportunity to remedy such default events following their occurrence. And basically that means there's no immediate right of termination. And I point this out because it's distinct from the limited but immediate rights of termination that sit under the operative provisions in the Framework Funding Agreement, which I'll discuss as part of the next slide. So if we could move to the next slide, please. So firstly, significant events. These also remain unchanged, and they are effectively any adverse regulatory action being, in summary, adverse comments or findings made by a court, tribunal or other statutory body relating to the conduct or performance of the recipient that impacts on its reputation, or other significant matters, including commencement of legal, regulatory or disciplinary action involving the recipients or its representatives that may adversely impact on the compliance by the recipient with Commonwealth laws or policy, or the reputation of Housing Australia or the Commonwealth. The Framework Funding Agreement also includes 3 events, the occurrence of which allows for immediate termination. These are insolvency of the recipient, an unauthorised change of control of the recipient, and an act of dishonesty or fraud. And Housing Australia has the right to terminate the Framework Funding Agreement and all of the underlying project agreement where any of these events occur. I should note that Housing Australia can elect to follow the process outlined in the project agreements that relate to the market process for each of the projects where it determines it wishes to only terminate a single project agreement. Based on feedback, changes were made to the Framework Funding Agreement in this aspect to allow for Housing Australia to elect to only terminate a single project agreement following an act of fraud or dishonesty, but I note that this is at the discretion of Housing Australia. Next slide, please. The default and termination process is generally the same as what was included in the common terms that went out for consultation in December. And it's set up there on the slide. Some changes were made, but these were minor in nature. And I don't propose to go through each step in detail on the basis that the default and termination process is relatively standard, other than as previously presented to the market, where the remediation of a default event is not achieved or Housing Australia is entitled to terminate a project agreement, there is a detailed market process to be followed, either by the recipient or Housing Australia, to seek to have the specified dwellings leased or sold to another party who is able to meet all of the obligations set out under the applicable project agreement, and this will be done by way of novation. If a default event is not remedied during the development phase, if the market process is unsuccessful and Housing Australia is entitled to terminate the project agreement, or Housing Australia is entitled to and does terminate the Framework Funding Agreement, Housing Australia has no obligation to make any further payments, and the recipient has no entitlement to make further claims against Housing Australia. Where the market process is successful and the project agreements are novated to a third party, the payments will continue. It's also worth noting that a right to terminate a project agreement doesn't automatically give rise to Housing Australia for a right to terminate other project agreements, i.e. there is no cross default at that level. That only occurs and only is an ability of Housing Australia where it has the right to terminate the Framework Funding Agreement for the limited reasons outlined above, being insolvency, unauthorised change in control, and dishonesty and fraud. Next slide, please. Other changes that have been made relate to tenure eligibility and change in cohort requirements, and these are again based on some of the feedback received. Prior to the operating phase commencing for each type of housing, the recipient must prepare the tenant policies for the applicable type of housing being provided, either social or affordable. For social housing, the policy must be consistent with all laws and policies in the relevant jurisdiction relating to tenant eligibility, including for people in acute housing need, rent settings for social housing as applicable, And if there aren't any such laws or policies in place, the tenant policy must align with those that relate to public housing in that jurisdiction. For affordable housing, the policy must include details of the recipient's approach to determine and monitor tenant eligibility for affordable housing, details of how the recipient will undertake testing to ensure the tenant meets and continues to meet on an annual basis the income eligibility requirements for affordable housing, and any other information as may reasonably be requested by Housing Australia. As noted up on the screen, a tenancy must be vacated if housing income equals or exceeds 125% of the then current income eligibility limit over a 12-month period. Recipients may submit a request to Housing Australia during the term of the project agreement, a right to replace a contracted tenant cohort. And this right accrues where they form the view that it's no longer practicable to accommodate the current cohort in whole or in part. If a request is made, Housing Australia may suggest an alternate replacement tenant cohort, in which case the recipient must engage in good faith discussions with Housing Australia, and Housing Australia will act reasonably in deciding whether to approve the change in tenant cohort. There isn't an ability to amend the type of housing a dwelling would be used for, meaning you cannot request a switch from affordable to social housing or vice versa. And in addition to this, there will not be a change to the financial model as part of any changes agreed as part of this process. Next slide, please. This slide looks at expiry obligations. The remaining tenant obligation has been reduced. It no longer requires alternative accommodation for affordable housing tenants and only requires the recipient to use its best endeavours to house social housing tenants with no minimum rather than the previous 2 years. The offer for alternative accommodation for social housing tenants must be made 90 days prior to the expiry of that term. An offer of alternative accommodation doesn't necessarily have to come from the recipient, but could come from the housing provider or a third party. In addition to this, there is no longer any requirement for security for the remaining tenant obligation. The clauses around the financial benefit obligation have now been enhanced. Where a recipient has undertaken to deliver financial benefits to a registered charity, the form and content of these benefits will be included as an obligation in the project agreement. Where the financial benefit is to be provided on or after the final expiry date, Housing Australia may register security to secure the delivery of those benefits, and such security will be released upon satisfaction of the financial benefit obligation. I'll now pass to Cathy Santikos, who will outline Housing Australia's position with regard to security under the funding programs. Thanks, Cathy.
Thank you very much, Nikki and Lisa, and good afternoon to you all. Housing Australia is adopting a pragmatic approach to the taking of security. Only concessional loans will be secured, and as Nikki mentioned, security may be required to secure any financial benefit obligation which arises post-expiry. No security will be required for availability payments. The concessional loans will be deeply subordinated in the sense that they will rank behind all other secured debt. So, for example, if you have raised senior debt from a bank or even from Housing Australia itself, that senior debt will rank first. To the extent to which you have raised other secured debt, whether mezzanine debt or debt from institutional capital even, that debt will also rank ahead of Housing Australia in the security stack. The form of security required will be assessed during the evaluation process and will depend on the financial model. The expectation is that for the majority of concessional loans, a registered real property mortgage over the land and a registered all-asset general security agreement will be put in place. There might be scope to limit the GSA to the project assets alone, if the recipient is undertaking other projects in the same vehicle. Housing Australia is receptive to considering a security trust structure in limited and appropriate cases where the other financiers prefer. Except in exceptional cases, there will be no upstream security required in terms of any shareholder or institutional capital support. Importantly, there will be no covenants on title. Where other secure debt is in place, there is an expectation that a financier tripartite deed or an intercreditor deed will be entered into, and I use those terms interchangeably. The financier's tripartite deed or intercreditor deed will serve a dual purpose. It will set out the priority cascade for the secure debt, with Housing Australia's concessional loan ranking last. And where the senior financier requires, Housing Australia will also grant step-in rights or cure rights to the senior financier. The financier tripartite deed will give the senior financier the right to remedy breaches of the project agreement by the recipient if they elect to do so. The senior financier will be able to submit a cure plan to Housing Australia to overcome the breach. The cure period can be up to 6 months, but must be justified by reference to the nature of the underlying default. Housing Australia will not take any enforcement action until the senior security has been discharged, but will expect to receive reasonable information and updates about the senior's enforcement process along the way. You'll be pleased to know that no other site deeds are contemplated in the structure. For example, there is no requirement for a builder side deed during the development phase, and there's no requirement for an operator side deed during the operating phase. In summary, therefore, Housing Australia's approach to security for concessional loans is streamlined. It's flexible, and it allows the senior debt the opportunity to cure breaches by the recipient at its election. And just to also confirm that there is no security required for availability payments. Back to you, Nikki. Thank you.
Thanks, Kathy. This slide is a summary of the changes that have been made to the funding documents following market feedback. Most of these changes I've already been through on earlier slides, but I'll just touch on the remaining few. Firstly, we've included a termination right for the recipient. So the recipient now has a right to terminate a project agreement where Housing Australia has not paid the recipient a quarterly availability payment in accordance with the project agreement and has not remedied its failure within 6 months of receiving notice to do so. Secondly, there are requirements relating to any authorised assignment and novation of the project agreement have been modified, including that the requirement for any incoming nominee to have a same or improved creditworthiness has been removed. We've introduced know your client or know your customer requirements. And where a change in the housing provider is proposed, the drafting now clarifies Housing Australia's expectations with respect to the transfer of tenants. Also included now is a more detailed dispute resolution provision, which includes expert determination. And finally, based on feedback, the change in control thresholds have been increased from 25% to 35%. Now, I appreciate there has been quite a bit of information to take in. So I'm going to wrap it up here and hand back to Lisa at Housing Australia to close out this session. Next slide, please.
Thanks, Nikki, and thanks, Kathy. That was a great presentation. And thank you to everyone else for dialing in today as well. I hope that was informative. For more information about the program and to access a range of fact sheets, please visit the Housing Australia website. In terms of next steps, we are proposing to make some guidance notes on specific matters available in the Housing Australia portal shortly. As I mentioned earlier, the funding documents are now in the Housing Australia portal. For those people who are registered, you can download them and take a look through them. Some reminders of key dates. The applications for funding round 1 must be submitted by the closing date and time, which is 2 p.m. Australian Eastern Daylight Savings Time on the 22nd of March 2024. And a reminder that a recording of this session will be available in the portal in the coming days. So thank you so much and have a great day.